Good morning, dear students. Very good morning. We were into the discussion of the portfolio management. Till now, we have covered quite a good number of concepts. And what we have ended up in the last session was the capital asset pricing model, right? So wherein we have boiled down to the formula of required return being equal to the risk-free rate plus beta into RM minus RF, where beta was representative of the systematic risk. So that systematic risk was calculated by multiplying correlation with the standard deviation security by standard deviation of the market. And beta is also going to be calculated as covariance between security and market upon the variance of the market. Okay. And we also stated that in the capital market line as compared to that, the securities market line which we have, there the slope is essentially the this RM minus RF upon standard deviation of the market. Okay. But over here we have the beta as the slope. Okay. So let's just take up few questions. Okay, and then we will go for some more discussion. So the question that we will take up right now is going to be question number 8. So let's take up the question number this time. Yeah, let's try to take up this question number 8 now. It's question 8. We have to compute the beta value of Krishna Limited at the end of 2015, and we have to state our observations. Okay. So let me just copy down the question. Okay. So here we have these numbers. So we have the prices and dividend and average market index and the dividend yield and also the risk-free rate. We have to compute the beta. So to compute beta, we will need the rate of return from the Krishna Limited. So we'll say here price, dividend per share, and then we'll talk of return of the security. So here it is 2012, 2013, 2014, 2015. So prices are 245, 253, 310, 330. Dividend per share is 20, 22, 25, and 30. So let's talk of return of the security. Okay. So return of the security is simply going to be 253 minus 245 plus 22, the whole thing divided by 245. Right. So this works out to be a return of how much? 253 minus 245 plus 20 is 28 divided by 245. One second. 253 minus 245 plus 22 divided by 245. Yes. There is some problem with 253 minus 245.
3.27%.
33. 33 divided by 245. Okay, so return of security is is it? There seems to be something wrong with this. 253 minus 245.
3.27%.
22, which is 30, and 30 divided by 245. Yeah, 12.24%. Because the whole needs to be divided by 245. Then we have 310 minus 253, then plus 25, this divided by 253, which is 32.41%. 330 minus 310, which is 20, plus 30, which is 50, divided by 310. That's 16.13%. Okay. That's the return of the security. Now coming to the return of the market. So for return of market, we have the value of index, right? And that value of index will be given as average market index is 2013, 2130, 2350, 2580. This is the value of index. Then we will say what is the appreciation in price. Appreciation in index. So appreciation index is 2130 minus 2013, which is 117 divided by 2013, which is 5.81%. Then we have 2350 minus 2130, divided by 2130, which is 10.33%. Then 2580 minus 2350, which is 230 divided by 2350, which is 9.79%. Then we also have the dividend yield. So dividend yield is given as 5%, 6%, and 7%. So if I ask you what is the market rate of return, just need to add both of them, which will be 10.81%. Then it is 16.33% and 16.79%. Okay. So now to get the value of beta, we need n summation of return of security into return of market minus summation of return of security into summation of return of market, the whole divided by root of n summation of return of security square minus return of security the whole square. Right, so we just need this particular formula is over here. Okay, instead of RS it will be RM. Yeah. RM. Okay. So this is the value, these are the values that we need. So for this, we need to take the return of security and return of market total, and we need to have columns as return of market square and also return of security into return of market. Okay. So can we just calculate and substitute in this and get me the value of beta, guys? Can we do that? Yes. Everyone?
Yes. Yes.
Yeah, sure. Quickly do it, guys. Just get me these 4 totals, substitute over here, and then get the value of beta. The total of return of security should be what?
60.78.
60.78. Yes. Return of market total is
43.93.
43.93. Market return square is totaling to
665.43.
665.34.
43.
43. Okay. And the product is going to be
You're doing
932 point something.
and 932.39.
932.29.
39. 39.
0.39. Okay. So let us just substitute the numbers over here. And this is going to be like 3 into 932.39 minus summation of RSA 60.78 into 43.93 divided by, sorry, the one by square root, divided by 3 into summation of RM square, which is 43.93 minus summation of RM the whole square. So this is what? Yeah, 665.43 minus 43.93 square. Okay. What's the total?
Yeah, 15.6.
15.6. Is it?
Yes.
No. Are you talking of only the numerator value?
The total beta value.
No. So just check 3 into 932.39, which is 2797.17 minus 60.78 into 43.93, which is 2670.07, the whole divided by 3 into 665.43, which is 1996.29 minus 43.93 square, which is 1929.85. So if we solve it, 2797.17 minus 2670.07, that's 127.1 upon 1996.29 minus 1929.85, which is 66.44. Yeah, so 127.1 divided by 66.44, which is 1.91. Got it? 1.91 is the answer, guys. This simply means that this 1.91, it means that if market moves by 1%, right? Security return is likely to move by 1.91%. Okay, that's a simple interpretation because that's indicating the volatility of the security with respect to the market. Okay, then let's take up another question. Question number 9, guys. Yep. So we have to compute the expected return from security F and also the market portfolio. Covariance between market portfolio and security and the beta for the security also needs to be computed. So we have the probability numbers and the security F and market portfolio returns, right? We have, this is question number 9. So we have probability, then security F and the market portfolio. So 0.3, 0.4, 0.3, 0.3, 0.4, 0.3. Security F is having 30, 20, 0, and portfolio is having minus 10, 20, and 30. So these are the returns. Now we have to compute the beta. Okay. So now to compute the beta, we definitely need the expected return. So first we need to get the expected value of F and expected value of P. So how do we get the expected value of F and expected value of P? That's going to be summation of probability into F, and this is summation of probability into P. Probability into F, then we have probability into P. Okay, so probability into F and probability into P. We just need to take the total of this to get the expected values. And once we have got them, we need to look at F, since we want to get the value of beta is going to be summation of probability into F minus F bar into market portfolio return minus P bar upon summation of probability into P minus P bar square, which is nothing but the variance part. Right? So covariance upon variance. So this portion is your covariance and this is your variance. So we need to take F minus F bar, P minus P bar, then probability into F minus F bar, P minus P bar, and also we need probability into P minus P bar square. So we need these totals, guys, to get the value of beta. So first we calculate the probability into F, probability into P, and then these four totals. These are going to be the numbers over here. And once you get the F bar and P bar, then we have to calculate the beta. Can we complete the calculations quickly? Everyone?
Yes. Yes.
Yeah, quickly, guys. The total of probability into F, that's 17. Then probability into P, totaling 14. The product should be minus 168. And the last column should be totaling to 264.
Yes.
Yeah. So we
Yes.
have this as 17, 14. And now we can simply substitute this as 264 upon, no, not 264. It is minus 168 upon 264. So how much is the beta? Minus 0.64. Right? So beta is minus 0.64.
Right.
Okay. Perfect. Sure. Great. Now, let me just have a question which is really good. Yeah, look at this question number 20, guys. Question number 20. So assuming that shares of ABC Limited and XYZ Limited are correctly priced according to capital asset pricing model, the expected return and the beta from the shares are given by. So we have the beta and the returns available to us. We have to derive the securities market line. So we have beta, we have the expected return of the security. What we don't know is the expected return on market and the risk-free rate. We don't know what is RM and what is RF, right? So let me just take this particular piece of information and try to draw or try to evaluate what is the securities market line or the CAPM line. Of course, in both the cases over here, for both companies, we don't know what is RM and RF. In fact, RM and RF are going to be the constant over here. So for ABC, can I say it will be RF plus 1.2 into RM minus RF will be equal to 19.8, correct? So this will be RF plus 1.2 times of RM minus 1.2 times of RF is equal to 19.8. So let's bring together 1.2 RM minus 0.2 RF is equal to 19.8. Okay, so that's 1.2 RM minus RF minus 1.2, which is minus 0.2 RF is 19.8. So this is equation number 1. Then for XYZ, it is going to be RF plus 0.9 into RM minus RF, and this is equal to 17.1. So therefore, we can say RF plus 0.9 RM minus 0.9 RF is 17.1. So this is 0.9 RM, and then we have like what, 1 minus 0.9, so plus 0.1 RF is 17.1. So this is our equation number 2. So can we solve these two equations and can we solve this equation and get the values?
Yes.
Yes. So 1.2 RM minus 0.2 RF is something. And then we have 0.9 RM plus 0.1 RF is 17.1. Well, to make it solve easier, we can simply say multiply by 2. So if you're going to multiply this by 2, this is going to be what? 1.8 RM plus 0.2 RF is equal to 34.2. So this is equation number 2. Okay. So try to solve both of these equations and get us the value. Get the value of RM and RF. Simultaneous equation. I hope you're aware of it.
$18. RM is 18.
How much?
RM is 18.
Okay. RM is 18. Okay, market rate of return is 18%. What is RF?
Uh, 0.9.
0.9, or is it 9? RF should be 0. It should be 9%. Just verify. RF should be 9%. You can just substitute this 18% in any of these. I mean, you have to substitute this 18 over here. So 1.8 into 18 plus 0.2 RF is equal to
Yes, 9%.
34.2. It's 9. Perfect.
Yes, yes,
Okay.
9%. Yes.
So our CAPM, or the securities market line that we say, it's going to be, RF plus beta into RM minus RF. So RF is 9% plus beta into 18% minus 9%. So that's 9% plus beta into 9%. Right? That's your securities market line, or the CAPM line. That's the securities market line or the CAPM line. Okay. Is it fine?
Yes.
Yeah. Okay. Fine. Question number 20 is done. Now let us take up.
We don't have to find beta in this question.
No, beta, beta is dependent on the company, right? We wanted to know what is the RM and RF so that we frame the equation. So if you want a return for any company, we can simply substitute the beta of that company and get the return of that company.
Right.
Right? Yeah. Okay, so let us take up the next model now, because we're through with the CAPM. Now, the next model that we have is something called as Sharpe single index model. Sharpe's single index model. Okay. Then this single index model, we calculate something called as another CML, but it's not capital market line. It's called as characteristic market line. This is obtaining something called as characteristic market line. Okay. Are we generally aware of something like this, y equal to mx plus c? Yes or no?
Yes.
We are aware of this, y equal to mx
Yes.
plus c.
Yeah.
Where have you seen this particular form? Where have you seen this form? In I suppose in geometry, or in your foundation days also, you might have learned that this is the equation of a line. Right? This is a general form of a equation of a line. So general form of equation of line is y equal to mx plus c. We have the general form of equation of a line to be stated as y equal to mx plus c, where we say that m, what is this m? Can I say slope? And c was a constant form. Right? Yes or no, guys?
Yes. Yes. Right.
Now,
We would generally write it y is equal to ax plus b.
AX plus B. Yeah, whatever. I mean, the notations may differ, right?
Yeah.
Now, similar to that, we are going to have in the Sharpe single index model, we say return of a security is going to be beta into return of market. Return of a security will be defined as beta into return of market plus alpha, right? Where beta is definitely the slope and alpha is a constant. Okay. And this alpha is going to be computed as uh, average of return of security minus beta into average of market. Average of return of security minus beta into average of market return. Okay. So return of security is beta into RM plus alpha. So beta is a slope, alpha is a constant, which is calculated as average return of security minus beta into average return of market. Okay. So this is generally the equation that we have from which we are going to form the characteristic market line. Okay. Now, to form this equation, we first need to get the value of beta. And also, once we get the value of beta, alpha can also be obtained. So let us take this particular question for understanding this characteristic market line. Yeah, this one. So this is like a return of A and the return of market portfolio is given. We need to obtain the characteristic line, and then we will talk about something called as the systematic and the unsystematic risk. Okay. Now, let's talk about it. So we have return on A and return of the market portfolio. So we have return of security, return of market. So return of security is what? 12, 15, 10, 2, 10 minus 12. So it is 12, 15, 11, 2, 10
10 minus 12.
minus 12. And then market returns are
8,
8,
12, 11.
12 minus, okay, you have the number. You might be having this already. So this is 8,
8, 11, 12, 11,
11
minus 4,
minus 4
9.5, minus 2.
minus 2, right?
Yeah.
So we have the return of security, return of market. So we first need to get the value of beta, guys. Now to get the value of beta, you're going to do it as n summation of RM into RS, which is return of market minus return of security, minus summation of return of market into summation of return of security, the whole divided by n summation of return of market square minus summation of return of market, the whole square. Okay. So we have RM into RS. We need definitely these total and also this one. And we also need RM square. Okay. You just calculate these totals, substitute in this, and then get the value of beta, guys. This is 508, and then market return square should be 439.25. Are we getting this? Just verify these numbers, guys. Then just calculate the beta and let me know what's the value.
1.20.
1.20. Is it exact 1.20 or something ahead?
$1.2018.
Okay, 1.2018. Okay. So 1.2018 is the beta value, right? Now, to get the equation of return on security is equal to beta into beta is what we have got. We need to also get the alpha. Now for alpha, we need average of security return and market return. So average of security return is going to be 38 by 6. 38 divided by 6, which is 6.33. Average of market return is 34.5 divided by 6. So average of market return 34.5 divided by 6. This is what? 5.75. Okay, so we have beta. We have the average return on security. And then we talk of the characteristic market line. So characteristic market line is going to be the return of security is equal to beta into RM plus alpha. So first we need to calculate the alpha over here. Alpha was average return of security minus beta into average return of market. So average return of security is 6.33 minus beta is 1.2018 into 5.75. So what is the alpha? What is alpha? 6.33 minus 1.2018 into 5.75. How much is the alpha is?
Minus 5.8. 0.58.
Minus 0.58. Okay. So we have the return of security to be defined as 1.2018 into RM minus 0.58. So return of security is 1.2018 RM minus 0.58. Okay, minus 0.58. That's your characteristic market line. Now let me tell you what is so special about this characteristic market line. By the way, this is not something which is return of security is going to be calculated exactly. Rather, this return of security that we have set the formula here is actually estimated return of security. So estimated return of security is 1.2018 RM minus 0.58. Estimated return of security is going to be 1.2018 return of market minus 0.58. Right, so 0.58, that's the alpha. This is what we are talking of estimated. Now, what is so special about this estimated return of security? Okay, let me just tell you what is this all about with the help of a graph. Okay, we have this return of security, return of market. If I add just one more column, which is estimated return of security. Okay, so if I just add one more thing called as the estimated return of security, right? So we can definitely get certain values over here. Estimated return on security will be 1.2018 into market return is 8 minus 0.58. So how much is this? 1.2018 into 8 minus 0.58. What is the estimated return of security?
9.0344.
9.03.
44.
Okay, 6. Then for the second year, it will be 1.2018 into 12, because here the market return is 12 minus 0.58. This is equal to 1.2018 into 12 minus 0.58.
13.8416.
13.8416. Then 1.2018 into 11 minus 0.58. How much is the estimated security?
12.6398.
12.639. Then the fourth one, 1.2018 into minus 4 minus 0.58. What is this return?
Minus 5.3872.
Minus
5.3872.
3872 to 387. Okay. Then last we have 1.2018. No, one more number is there. Into 9.5 minus 0.58. What is this number?
$10.8371.
10.8379. Okay. Then we have 1.2018 into minus 2 minus 0.58. So what is this number?
Minus 2.9836.
Minus
2.9836.
Okay. So this is what is the estimated return of security is. So these are all the values of estimated return of security. Now, these are the actual return of securities, and these are estimated return of securities. Now, what will happen if I just try to plot both of them together? Right. So let me just show you how that would really look like. Okay, this is what the chart will look like. Okay, I think it just went up. I hope it just works up right now. It's showing the same error like the last time. Anyways, I'll just share it from other device. Can we see the screen? The Excel chart?
Yes, yes.
Yeah. So you can see very clearly that so in this chart, the blue dots that you see, those are your actual return of Y. Whereas the orange dots that we see, those are the estimated return of y. So what can you draw, conclusion or any inferences from this diagram? Any inferences can you draw from this diagram, guys? The actual returns may be scattered, but can I say the estimated returns are forming a straight line?
Yes, they are in a straight line and their
Straight line.
others are
And
scattered.
the straight line that we form is actually passing through, in between the scatter plot. Am I right?
Yeah, right.
And this regression, this particular line that we call it as a characteristic market line is actually a regression line of the security returns on the market return. Have you learned the regression earlier? Maybe in foundation. There are
Yes,
two types of regression: y on x, x on y.
yes,
Right. So this is the return of market on the security return of security on the market return. So we have the blue dots, which are the actual returns, and the orange ones, which are the estimated one. And the estimated ones are basically a straight line that we have here. Okay, the estimated is a straight line that we have over here. Okay. So the estimated line is forming a straight line. And of course, the thing that we observe is the actual returns and the estimated returns. Are they equal or there is some difference between them? The actual return and the estimated returns, are they same?
no, there is difference.
There is a difference. The actual return and the estimated returns are different numbers, right?
Yes,
Actual returns and the regress returns are different numbers. So they are, as they are different numbers, since they are having a different numbers, there is some sort of error which we are getting it, right? Right. So let me just come back to my original screen. Yeah. So our actual return was 12 and estimated return is 9.036. So do we find any error happening over here? What is the error? How much is the error, guys? We estimated it to be 9.036, but the actual return is 12. So what is the amount of error that we have? How much is the error in our estimation? First up, is there an error in our estimation?
yes.
Yes. How much is that? Then I said 12 minus 9.036.
Yeah, 2.964.
2.964. Right. Same way, what's the error in the second case? 15 minus 13.8416, which is 1.1584.
Yes,
Then,
1.154.
yes, this is minus 1.639, right? And then 2 minus of minus. So this is what? Minus 7.387. No, it is plus, right?
Yes,
7.387. What's the error in the next one? Minus 0.8379. And how much is the error in the last one? .9836 minus 12.
minus 9.0164.
0164. Can you just see what's the total of error? What is the total of error over here? Add up all the total, all the error terms and see what's the total coming out to be.
Is 0.0165.
That's literally zero, right?
Right.
Some rounding of error is there, but total of error is always going to be zero, guys. Okay, so just take a note of it. The total of errors is always going to be equal to 0. Now, coming back to our security, we said that estimated return of security is beta into RM plus alpha. Estimated return of security is beta into RM plus alpha. Okay. So we know that error was the return of security minus estimated return of security. So if I want to calculate the actual return of security, right, can I say it will be error term plus estimated return of security? Correct?
Yes.
So return of security will be estimated return of security plus the error term, or to be specific, we can say, sir, estimated return of security was anyways this. So this is beta into RM plus alpha plus error term. Return of security is beta into RM plus alpha plus error term. Right?
Right.
So beta into RM plus alpha plus error term. Return of security, we say it is beta into RM plus alpha plus error term. So when you add the error term, the actual return of the security becomes a complete equation. Okay. Now from this equation, we can actually derive it. What is the total risk and what is the systematic and unsystematic risk. So let me just quickly derive it from here. Since this is the equation, let us do one thing. Apply variance throughout. So let us apply variance throughout. So just like our return of security is beta into RM plus alpha plus error term, we will say variance of return of security will be variance of beta into RM plus variance of alpha plus variance of error term. Does it make sense to you guys? Yes or no?
Yes.
So we just applied variance throughout. Okay,
Right.
so variance of the security can be written like this, variance of return. Okay, that is equal to variance of beta into RM plus. What can you say about variance of alpha? Alpha is a constant term, right? Because alpha is what we got over here as minus 0.5. Alpha is a constant term. So alpha is a constant term minus 0.58. So what will be the variance of this alpha? Is there any variance in alpha? Is the value of alpha changing or is it a constant term?
It's constant.
Constant term. So what can we say about the variance of alpha? Can I say it will be 0?
Yes.
Plus variance of error can be written like this. Variance of error. Okay. Now, let me just do some working over here to make it more clearer. Variance of beta into RM. The formula for, sorry, we'll have a square over here also, right? So standard deviation is this, and if I just take a square, the square root gets removed. So we have variance of beta into market as what? Summation of, the formula wise, we have summation of beta into RM minus beta into RM average upon n, the square. Am I right? Makes sense, everyone?
Yes.
So from this, we can actually take summation of, beta outside Rm minus Rm bar, this whole square upon n. And then since this will be beta square into Rm minus Rm bar square upon n, and beta square is a constant term. So since beta term is a constant term, we can take it common outside. So beta square into summation of Rm minus Rm bar square upon n. Can you tell me what is this term? Can I say that is variance of market?
Right. Yes.
Right. So I can actually write this formula as variance of market, variance of security return is going to be equal to beta square into variance of market return plus variance of error term. Now this entire expression, boils down to everything. This is your total risk. This is the systematic risk. And this is the unsystematic risk. So whatever variance we calculate, that's the total risk. Whatever beta square into variance of market we calculate, that's systematic risk. And the variance of error term is unsystematic risk. Now in this case, do we have the variance of security return? Not yet. Do we have the beta value? Yes, we have the beta, but we don't know what is the variance of market and we don't know what is the variance of error term. So let us write down first return of security, return of market, and error term. Okay. So return of security is what? 12, 15, 11. Right. Return of security is 12, 15, 11, 2, 10, and minus 12. Return of market is 8, 12, 11, 4, minus 4, 9.5, minus 2. And then we have the error terms. The error terms that we computed over here, 2.964. And then we have 1.1584.
1.15. Yes.
Then next is minus 1.639. Then 7.387. Okay. And minus 0.8379.
7.
And then we have minus 9.0164. So we have the return of security, return of market, and the error term. We want total risk. Total risk will be equal to variance of the security return. So variance of security return can be simply obtained as summation of security return square upon n minus average return of A. So we need R square. Systematic risk is going to be beta square into variance of market, which will be beta square into variance of market is summation of market return square upon n minus average market return square. Okay, so we need like market return square. Unsystematic risk is variance of error term, which will be summation of error square upon n minus average of error. So we'll need to take the square of it. So now we just need to calculate the values and substitute in this formula to get the total risk, systematic risk, and the unsystematic risk. So can we do the calculations?
Yes.
Yeah. Go ahead, guys. Calculate the total systematic and the unsystematic risk.
Yeah, total
Yes.
risk is
What is R
123.
square?
R square 738.
738.
Yes.
Okay. Market return square. I think this is what we have done already. Market return square is 439.25,
Yes.
right? And error square, total of error square,
149.3716.
149.3716.
716.
Okay. So total risk is
123.
how much?
123.
Total risk is 123.
Yes.
It should be 738 upon 6
Yes.
minus average return of R
Yes.
was
Yes.
what? 6.33. That's 40.07. Then 738 divided by 6 minus 40.07. That's 82.93.
82.93.
82.93. That's
Yes.
total risk 82.93. Then how much is the systematic risk number?
It comes to
Beta is already what we have computed. Beta was what? 1.2018.
1.2018.
1.2018 into variance of market, which is 439.25 upon 6 minus average return of market was 5.75.
5.75. It comes to 97.41.
90? No.
There will be
Just
1
check.
point beta square. Beta square
beta
is 1.2018 whole square.
Okay. 9.25, rather like 5.75 square is 33.0625. It's 33.0625. That's 40 into 1.2018 into 1.2018, which is 57.98. Okay. Then this is 149.37 upon 6 minus 0 anyways. So 149.37 divided by 6, which is 24.895. So 82.93 minus 57.98, which is 24.95, or roughly it is going to be the same part. Clear, guys?
Clear.
So approximately it's going to be the same, just rounding up errors. We may have something here and there. Is it clear, everyone?
Clear.
So that's how you compute the systematic risk and the unsystematic risk from the given data. Now, let us take up another question. Which is question number 12 can be done on a similar line. Okay. Then let's take something really good question with regards to this. Yeah, this one. Question 33 is. Let's try out this question 33 now. Following are the details of a portfolio consisting of 3 shares. So in our portfolio, we have 3 shares ABC with their respective weights as 0.2, 0.5, 0.3. Right? And then we have the beta values, the expected returns, and the total variance numbers. So these are the variances of ABC. Market portfolio standard deviation is 10%. You're given the following additional data. Covariance between A and B is 0.030. Covariance between A and C is 0.020. And covariance between B and C is 0.040. We have to calculate the portfolio beta, residual variance of each of the 3 shares, portfolio variance using Sharpe index model, and portfolio variance on the basis of modern portfolio theory given by Markowitz. Okay, so let's try to calculate a portfolio beta and all other parts. Let me just write down first the data that we have. So we have A, B, C, 3 securities. Their weights are given to us to be 0.2, 0.5, 0.3. The betas are 0.4, 0.5, 1.1. Then we have the expected returns, which is 14, 15, 21. And then we have the total variance. Total variance is given as 0.015, 0.025, and 0.1. Okay, that's a total variance. Then we also have the standard deviation of market to be 10%, which is 0.1. Then we have covariance between A and B to be 0.03. Covariance between B and C 0.04, and covariance between A and C is 0.02. So we have this covariance numbers. Now we have to calculate first up the portfolio beta, the residual variance. Residual variance is basically variance of the error term using Sharpe index model, and then portfolio variance based on the modern portfolio theory by the Markowitz. So let's first calculate the portfolio beta. First part is to calculate portfolio beta. So how do we go about calculating the portfolio beta? Well, portfolio beta is nothing but weighted average beta. This is going to be just the weighted average beta. So weighted average beta is going to be summation of weights into beta. So summation of weights into beta, which is going to be simply 0.2 into 0.4 plus 0.5 into 0.5 plus 0.3 into 1.1. So what is this portfolio beta, guys? Calculate the portfolio of our beta. Sorry, beta of our portfolio. My bad. What's the beta of our portfolio?
0.66.
0.66. Okay. So this is 0.66. Okay. Then the next thing that we are supposed to calculate is the residual variance of each of the three shares. The residual variance is basically the unsystematic risk. Now, for residual variance, we have the three securities A, B, and C. We'll talk of total risk. Total risk. Then total risk is basically variance square, or as per the information we have the total variance 0.015, 0.025, 0.1. That's a total risk. Now from that we are going to subtract the systematic risk. So systematic risk is beta square into variance of market, right? So beta square into variance of market is, we have the beta values as 0.4 square and variance of market is 0.1, right? So this is going to be 0.4 square into 0.1. So what's the systematic risk number? 0.4 square into 0.1, which is
0.016.
Beta square, and the variance of market is given to be 0.1, right? 0.4 square into variance of market 0.1, 0.016. 1 second. Some problem. What is this given to? Actually, this is standard deviation. So this will be also square. Yeah. That's what I was thinking of. How can the systematic risk be more than the total risk? Okay. Anyway, so 0.4 square into 0.1 into 0.1, which is 0.0016. Okay. Then what is the systematic risk for B? It is going to be systematic risk for B is going to be
0.5 square
0.5 square, yes.
into
0.5 square into 0.1 square.
0.1 square.
So 0.5 square into 0.1 into 0.1, which is 0.0025. So this is 0.1. Then what about the systematic risk of this? This beta is 1.1, right? 1.1 square into 0.1 square. 1.1 square.
0.0121.
0.0121. Right? So what will be the unsystematic risk now? The unsystematic risk, or what we call as the residual variance. Unsystematic risk or the residual variance. Just the subtraction between them,
Yes.
which is 0.015 minus 0.0016, 0.0134, 0.025 minus 0.0025, 0.0225, and then we have 0.1 minus 0.0121, which is 0.0879. Okay. That's your unsystematic risk.
Yes.
Got it, guys?
Yes.
Yeah. So that's the second part of the question, which is the residual variance. So that is done. Residual variance of each of the things. Then the third one is portfolio variance using Sharpe index model. Portfolio variance using Sharpe index model. Now, how do we get the portfolio variance using Sharpe index model? Let's have a look at it. Just like we had variance of security is equal to beta square into variance of market plus variance of error term. Barabar? Correct? Variance of security is beta square into variance of market plus variance of error term. Same way, can I have variance of portfolio equal to what? What will be variance of portfolio equal to? Variance of portfolio will be equal to beta of portfolio square into variance of market plus variance of error of portfolio. So throughout we are applying that portfolio aspect, right? Correct, everyone?
Yes, correct. Right.
Yeah. So now the question is, okay, we have the beta of portfolio. We have computed the beta of portfolio. We know the variance of the market plus variance of error of portfolio. Variance of error of portfolio. Well, the variance of error of portfolio is weight of x square into variance of error of x plus weight of y square into variance of error of y plus weight of z square into variance of error of z plus 2 into weight of x, weight of y, standard deviation of error of x into standard deviation of error of y, correlation between error of x and error of y. Now just tell me, what do you think, what will be the value of error of x and error of y? I mean, correlation between the two error terms. Yeah, what do you think? Will there be any relation between error terms, logically, can you have any relation between the error terms or the something which is unsystematic risk? Do you find any relation to be existing between unsystematic risk of one company and unsystematic risk of another company? There shouldn't be any correlation, right? Because totally unrelated things, both of them are. So we can definitely say that this is 0. So same way, the other 3 numbers are also going to be equal to 0. So essentially, variance of our portfolio using Sharpe index model is nothing but beta of portfolio square into variance of market plus weight of x square into variance of x plus weight of y square into variance of y plus weight of z square into variance of z. Okay. So what are the values of this? What are these terms, guys? Beta of portfolio. What is the beta of portfolio square?
0.66.
0.66. So 0.66 square into what's the variance of market? 0.1 square
0.8.
plus
0.1
weight
square.
of x square. What was weight? 0.2.
0.2.
0.2 square. And then variance of error of x is already calculated by us. This was variance of error of x, which is 0.0134. 0.0134 plus weight of y is 0.5 square
0.5.
into variance of error of y
0.0225.
0.0225 plus variance of z or
Weight
the
of z
part C, which is 0.3 square
into 0.0879 square.
into 0.0879
Square.
Take the total.
Should be square. 0.0879 square. 0.089 square. At the end.
0.08. No, why will you take square? This is already a variance term. So these terms need not be taken squared.
Okay, yes. Yes, right. Ze- 0.0184.
Sorry, how much?
0.01848.
Okay. 0.01848.
428.
Okay. That's the total risk or variance of the portfolio as per Sharpe single index model. Now, variance of portfolio as per Markowitz. Variance of the portfolio as per Markowitz. How does it look like? This is like weight of x square into standard deviation of x square or since we have here what A, B, and C, the weight of A square into standard deviation of A square plus weight of B square into standard deviation of B square plus weight of C square into standard deviation of C square plus
Twice.
2 into weight of A, weight of B into standard deviation of A, standard deviation of B into correlation you can do, or you can also say that this is covariance between A and B plus 2 into weight of B, weight of C into covariance between B and C plus 2 into weight of A, weight of C, covariance between A and C. Okay, so weight of A square. Weight of A square is
0.2 square.
0.2 square into variance of A
0.015
0.015
square.
plus
0.5 square.
0.5 square into
0.025 square.
0.025 square plus 0.3
3 square.
square into
0.1 square.
0.1 square plus 2 into 0.2 into 0.5 into what is the covariance between A and B?
0.03.
I think that is given to us. Covariance between A and B
0.03.
0.03 plus 2 into 0.3 into 0.5 into
B and C is 0.04.
0.04 plus 2 into 0.2, 0.3 into
0.02.
0.02.
2.
So you can just get the answer, and this is going to be the portfolio variance as per the Markowitz formula. What is this number is Markowitz portfolio variance?
Zero point 0.02146.
0.02.
02.
No.
Yes.
There seems to be some issue with this because weights what 0.2 into 0.5 into 0.03, 0.2 into 0.5 into 0.03, then 0.3 into 0.5 into 0.04, 0.2, then 0.2 into 0.3, 0.02. Yeah, it seems to be correct, but what is the number?
Yeah.
0.2. There is no memory, right? So 0.2 square into 0.015 square. That's m plus 0.5 into 0.5 into 0.025 into 0.025. That's again m plus 0.3 into 0.3 into 0.1 into 0.1 equal to m plus 2 into 0.2 into 0.5 into 0.03, again m plus 2 into 0.3 into 0.5 into 0.04. That is m plus 2 into 0.2 into 0.3 into 0.02. That's again m plus. And then we say memory recall. Yeah.
Yeah, this is good.
This is number 0.0214.
Yeah, 1465.
Yeah. 0.0214. Okay, so that's the variance of portfolio as per Markowitz formula. Clear, everyone? So portfolio variance, we can compute either of the approaches, Markowitz or the Sharpe, depending on what data is available for us. Clear, everyone?
Yeah, clear.
Okay. Now, let us do one more question. I have this question 36, guys. Just check if you can get it. So there are 4 securities with their betas given to us. Standard deviation of error term is given to us. The weightage is given. You are required to find out the risk of the portfolio. Basically, portfolio standard deviation is to be computed if the standard deviation of market index is given. So this is essentially the portfolio variance or portfolio standard deviation using Sharpe index. Try to solve this. Just try to solve this, guys. Try out question 36, guys. Similar to previous question, just that instead of 3 securities, we have 4 securities. Are you able to get it, or shall I start this?
If portfolio beta comes to 1.295,
Okay, that will be just the weighted average.
here.
So this is your question number 36. Let me just take this entire question there. Let's first talk of what is the portfolio beta. Portfolio beta is 1.60 into 0.25 plus 1.15 into 0.3 plus 1.4 into 0.25 plus 1 into 0.2. Okay. So 1.60 into 0.25 and so what is this number? Weighted average? What's this weighted average number?
Total comes to 1.295.
1.295.
5.
Right? Okay. Now, risk of the portfolio. So basically, variance of portfolio will be beta of portfolio square into variance of market plus weight of L square into variance of L, error of L, plus weight of M square into variance of error of M, plus weight of N square into variance of error of N, plus weight of K square into variance of error of K. So portfolio beta is 1.295 square into variance of market. So variance of market is what? 18%. So we need to take the square of this plus weight of L square is 1.25 square into variance of error of L, which will be 7 square, plus weight of M square is 0.3 square into variance of error of M, which will be 11 square, plus weight of N square is 0.25 square into 3 square plus 0.2 square into 9 square. Okay, so what's the variance of our portfolio using the Sharpe model? Yep, what is this number? Yes, add them all.
$561.11.
How much?
561.11.
561.11.
Yeah.
Correct. So that's the variance of the portfolio. Done, everyone? Variance of portfolio 561.11, guys. Okay, fine. So that was this particular question. Then let me just take you forward with the next concept, guys, or next model rather, in the portfolio management. So we are essentially looking at the last model that we have, which is called as arbitrage pricing theory. Okay, arbitrage pricing theory. It is again an offshoot extension from CAPM. In CAPM, we said that required return of our portfolio will be RF plus beta into RM minus RF, right? Which was nothing but risk-free rate plus beta into market risk premium, correct? Required return is RF plus beta into
Yes.
market risk premium. So required return is RF plus beta into market risk premium. That's your required return.
Yes.
Right?
Right.
But the problem with this CAPM model is that, it takes the entire market into consideration. That is, you're assuming that every company is going to have the same impact of macroeconomic situations, but it's not going to be the case. For example, if USD changes from 85 to 89, do you think this macroeconomic change is going to have same impact on all companies? Is it going to have similar impact on all companies? Or is it going to be different for a company dealing in overseas trade and the company which is not dealing in overseas trade? Am I right?
Right.
So if you are a company who is basically exporting, if your business is to export goods or to export software or any other aspect, then in such situation, can I say USD 85 to 89? Is it a positive news or is it a negative news? If you're an exporter, is it a positive news or is it a negative news for you?
Positive.
It's a positive news, right? Because you will be getting for every dollar instead of 85, 89. But on the other hand, if you're an importer country, if you're an importer company, then it'll be a negative news for you, right?
Yeah.
Right. So change in forex is not going to have same impact on the company. Even if you are an exporter, it may not have same impact for two companies. Similarly, if inflation changes from, let's say, 3% to 6%, do you think it is going to have a negative impact on all type of companies, or the impact may vary according to the type of company?
It will affect all the companies.
It will affect all the companies. Okay, my business is to manufacture salt. Do you think inflation from 3% to 6% is going to impact my business? I'm manufacturing salt. Do you think it's going to impact my business?
Not
No.
much.
No, because inflation is going to impact those companies which are dealing into what? Luxury and comfort. The companies which are into the business of necessities will not be impacted to that great extent due to inflation. right? So instead of having, just one single beta, um, we can actually think of having multiple betas. So the required return, which arbitrage pricing theory states, this is given like lambda 0 plus beta 1 lambda 1 plus beta 2 lambda 2 plus beta 3 lambda 3 till goes on till beta n lambda n. What is lambda 0? This is the risk-free rate. What is beta 1, beta 2, beta 3 till beta n? This is factor betas. Beta 1, beta 2, beta 3 till beta n. These are called as the factor betas. Okay. These are what we call as the factor betas. So factor betas could be like inflation factor, unemployment, or forex rate, or government policy, RBI repo rate. These are different factors that's going to impact the company returns. And we have lambda 1, lambda 2, lambda 3 till lambda n. These are nothing but factor risk premiums. These are the factor risk premium. So beta 1, beta 2, beta 3, these are the factor betas, whereas lambda 1, lambda 2, lambda 3, these are the factor risk premium. So every factor is going to have a different risk premium of its own, and that is what we are going to consider over here. Okay, so we may have like three factors. Let's say inflation, GDP growth rate, right, and foreign exchange rate. So we may have their betas. The inflation beta may be 1.1, GDP beta may be 1.03, forex beta may be 1.3. So what do you mean by this 1.1, 1.03 and 1.3? 1.1 means if inflation increases by 1%, security return will increase by how much?
1.1%.
1.1%. Perfect. Same way, in second case, if GDP increases by 1%, security return will increase by
1.03%.
Then, if forex rate increases by 1%, security return will increase by 1.3%, right? Right. So then we say what will be our, let's say factor risk premium. Factor risk premium. Let's say inflation is having a factor risk premium of 2%. GDP is having a factor risk premium of, let's say, 3%. And forex is having a factor risk premium of, let's say, 4%. So required return will be, let's say, this is our lambda 0 or the risk-free rate that we are talking of. Risk-free rate plus beta of 1.1 into 2% plus beta of 1.03 into 3% plus beta of 1.3 into 4%. So in this way, what is your required rate of return overall for this, guys? What's the required rate of return that we get? If we just add up all of them, we'll get the required return numbers. Let's check what's the required rate of return.
11.2.
11.2%. Okay. So that's 11.2%, guys. Okay. Now, let us do this question 37 now. So Mr. Tamarin intends to invest in equity shares of a company, the value of which depends on the various parameters as mentioned below. So GNP, inflation, interest rate, stock market index, industrial production. So we have beta, expected return, and actual value. If the risk-free rate is 9.25, how much is the return on the share under arbitrage pricing theory? Okay, so here we have factors 1, 2, 3, 4, 5. There are 5 factors. And we have the betas 1.2, 1.75, 1.3, 1.70, and 1. These are the betas. Now, what will be the lambdas? Lambda is basically the risk premium. So, risk premium is nothing but the difference between the expected and actual value. Okay. So, lambda is going to be expected value. Sorry, not expected, but actual minus the expected value. So, what is lambda 1, guys?
0.
0. Lambda 2. 1.5.
Yes.
Lambda 3.
1.25.
1.25. Lambda 4.
2.
2. Lambda 5.
5 minus
0. 0.5.
0.5. Yeah. So now what will be the required return as per arbitrage pricing theory? That will be lambda 0 plus beta 1 into lambda 1 plus beta 2 into lambda 2 plus beta 3 into lambda 3 plus beta 4 into lambda 4 plus beta 5 into lambda 5. So lambda 0 is 9.25% plus beta 1 is 1.2 into lambda 1 is 0. Beta 2 is 1.75 into lambda 2 is 1.5 plus beta 3 is 1.3 into 1.25 plus 1.7 into 2 plus 1 into 0.5. Calculate the total.
$17.4.
17.4. That's the required return as per arbitrage pricing theory, guys. Okay, try to quickly solve this question 39. We have the weightages and we have the betas over here. So first you give me what is the beta 1 of the portfolio. How do we get the beta 1 of the portfolio? Beta 1 of the portfolio will be what? 25% into 0.8 plus 10% into 0.9 plus 50% into 1.165 plus 15% into 0.85. Just add up all of them. And tell me what's the beta 1 of the portfolio. What's the beta 1 of the portfolio? This is 0.25. .25
It comes to 1.
comes to 1. Okay.
Yes.
Okay, that is 1. Then what is beta 2 of the portfolio? And same way get the beta 3 of the portfolio. Get me these beta numbers. Yes. What is the beta 2 of the portfolio?
Yeah, 2.105.
2.105. And what's the third beta of the portfolio?
Five 5.8.
5.8. Okay. So that's your beta. Now, using arbitrage, what is the expected return of market index? Now, this is obviously going to be 4.5% plus 1 into 6.85% plus 2.105 into minus 3.5% plus 5.8 into 0.65%. Yeah. Give me the total. What is this number, guys?
Is 6.91.
Market risk premium
6.9105.
6.91.
91.
6.91. Then they're asking if it is to be CAPM. CAPM, we can simply obtain it by taking only the factor 1 beta, which is the beta being taken. So that will be just this portion. Okay. Then Nirmal Kumar wants to construct a portfolio on only the small cap value and large cap. If the target beta is 1, determine the composition. So you can take weightage of this as weightage of, this as X, and this will be 1 minus X. And with the weighted average, that weighted average should be equal to 1. You can solve it and get the weights easily. Correct, guys? Yes. So you want to take these stocks, basically only small cap value and large cap growth. So you will take these betas and then compute the weight such that the portfolio beta is 1. Okay, fine.
Yes.
Yeah. Okay, so with that, let's just take now 15 minutes. We'll come back and do certain concept of performance evaluation, and that will be the end for our today's topic. Okay, so let's take a break right now, guys.
Okay.
performance measures of portfolio. That's the last concept that we have to cover in this topic. So performance measure of portfolio. Now, once we have created a portfolio and we are involved in management of the portfolio, we would like to know how well our portfolio has performed. Okay, we would like to know how well our portfolio has performed. So to test that, what is the degree of performance of the portfolio? What is the best way in which the portfolio has performed? We need some performance measures. So first performance measure is what we call it as Sharpe ratio. Sharpe ratio is essentially return of our portfolio minus risk-free. Can you tell me what is this numerator denoting? What is this numerator denoting is? Return of portfolio minus risk-free. Can you see this is telling us what is the excess return or what is the surplus or risk premium that we have generated? Now to generate this risk premium, do you think we would have taken some risk? Yes or no? Do you think we would have taken some risk?
Yes.
Yes. So I just can't be looking at this return of portfolio minus risk-free and say that I have generated a good positive portfolio return. Rather, I need to divide this by the standard deviation of the portfolio. So higher this number, or rather this Sharpe ratio is going to indicate what is the risk premium that we have generated, risk premium per unit of standard deviation. Okay. Then similar to this, we have trainer ratio. Trainer ratio is going to give us again the risk premium, but this risk premium is on per unit of beta. So the formula numerator remains the same, which is return of portfolio minus risk-free, but instead of dividing it by standard deviation of portfolio, they are dividing by beta. So return of portfolio minus risk-free divided by beta. Got it? That's the trainer ratio.
Yes.
Everyone? Okay. After trainer ratio, Sharpe ratio is done, trainer ratio is done. Then we have something called as Jensen's alpha. Now, what is this Jensen's alpha? Listen. Jensen's alpha is a return of our portfolio minus the CAPM return, or return of a portfolio minus required return as per CAPM. So this is return of our portfolio minus required return as per CAPM. Now required return as per CAPM is what? RF plus beta into RM minus RF. Now if this Jensen's alpha is positive, what does this indicate? Can I say it indicates return of our portfolio is more than the CAPM required return? Right? If this is positive, we say that the return of our portfolio is more than the
Yes.
CAPM return.
Right. Yes.
Then if this is negative, then we can say return of our portfolio is less than CAPM return.
Yes.
If my return of portfolio is more than CAPM return, can you tell me, has the portfolio performed good? I mean, has the portfolio performed more than the CAPM? Of course, more than CAPM, but has it performed better or has it performed worse?
It perform better.
Perform better. If your return of portfolio is more than the risk-free, I mean, more than the CAPM return, you can definitely say that the portfolio has performed relatively very good. Right? So, we can say, in first case, our portfolio has outperformed our portfolio has outperformed. Whereas if return of portfolio is less than CAPM, then we will say that the portfolio has underperformed. So portfolio, if if we say that this is 0, then can we say return of portfolio is equal to CAPM? Right?
Yes.
Then can I say the portfolio has performed at par? We will say the portfolio has performed at par. Correct, guys?
Yes.
Now,
Right.
do one question to implement this. Let's say rank the portfolio. Yeah, question 42. Let's do this question 42, guys. Five portfolios experience the following results during a 7-year period. So we have A, B, C, D, E. 5 portfolios. Their average annual return is this. Standard deviation is given, and the correlation with market returns is also given. We have to calculate a market risk. Market rate of return is just 14. Risk-free rate is 9. And then rank the portfolios using Sharpe method, trainer method, and the Jensen's alpha. Okay, so let me just take this question over there. Okay, so we have portfolios A, B, C, D, E. Portfolio A, B, C, D, E. The return of our portfolio is 19, 15, 15, 17.5, 17.1, and standard deviation is 2.5, 2.8, 2, and 1.8. We have the correlation with market. Correlation with market is 0.84, 0.54, 0.975, 0.750, and 0.6. Can we get the beta? Yes, we can get the beta, right? Beta is simply going to be what? Correlation into standard deviation of the security upon standard deviation of the market. And we know standard deviation of market is 1.2. So this is going to be what? 0.84 into 2.5 divided by 1.2. So what's the beta number? 0.84 into 2.5 divided by 1.2.
1.75.
0.84 into 2.5 divided by 1.2. 1.75. Okay. Then what about the second one?
Zero 0.9.
0.9. Then
0.65.
0.65. Then
1.25.
1.25.
25.
Then
0.9.
0.9. Okay.
Yes.
Fine. So we have this beta. Now, we have the beta. Now, can we get the Sharpe ratio? Sharpe ratio will be return of our portfolio minus risk-free rate is 9 divided by the standard deviation. So this is like going to be 19 minus 9 divided by 2.5. How much is this? 19 minus 9 divided by 2.5.
Four.
How much?
Four.
4.
Four.
Okay. What about the second Sharpe ratio? Second Sharpe ratio, which is 15 minus 9 divided by 2.
Three.
3.
Three.
Then
Third one is 7.5.
how much? 7.5.
7.5.
Okay. Then
4th is 4.25.
4.25. Okay.
Then 4.5.
4.5. Okay. And this is a Sharpe ratio. And can we give them a rank based on Sharpe ratio now? The best performing is 7.5 Sharpe ratio. Then
Yes,
the next
C.
is the last one. This is the
4.5.
third. This is the fourth and fifth. Okay.
Yes.
Fine. So that's the Sharpe ratio. Now, if you want to compute the next one, which is the trainer ratio. Trainer ratio will be return of portfolio 19 minus risk-free is 9 divided by beta is 1.75. So what's the trainer ratio?
5.71.
5.71. Similarly,
Yes.
get the trainer ratio for other 4 portfolios. What's the second trainer ratio?
6.67.
6.67. Okay. Then next one.
9.23.
9.23. Okay.
Fourth one is 6.8.
6.8. Okay.
The last one is 9.
The last one is 9. That's the trainer ratio. Then we have Jensen's alpha. Jensen's alpha, we know it can be computed as what? 19 minus RF is 9 plus beta is 1.75 into RM minus RF, and market rate of return is 14 minus 9. So how much is this Jensen's alpha coming out to be? (19 minus 9 plus 1.75 into 14 minus 9).
1.25.
1.25.
Yes.
Okay. Then 9. Then this return is what? 15 minus 9 plus beta is 0.9 into
0.9.
14 minus 9. How much is this Jensen's alpha?
1.5.
1.5. Okay. Jensen's alpha for the third one.
2.75.
2.75. Okay. Then
2.25.
2.25. Then
3.6.
3.6. Okay. So if you want to just give a rank based on trainer, it's going to be the first. No. The first rank will be 9.23. Then
9.23.
this will be second. This one will be third, fourth, and fifth. Correct?
Yes.
Then Jensen's alpha ranking, we can say
3.6.
3.6 is the best. There's the second best.
2.75.
Third is the best. Third position. Then 1.5 is the fourth, and the last one. 1.25 is the last performing one. Okay, clear, guys?
Yes.
Right. So in this way, we can rank the performance of our portfolios based on these ratios. Okay. Now it's time for certain MCQs before we complete the session today. So let me just quickly share with you the MCQ file. Okay, can we see the screen now?
Yes.
Yeah. Okay. So let's look at the first question. In Sharpe single index model, a return of a security is given as alpha plus beta into RM plus EIR. So what is this EIR error term representing? Systematic, unsystematic, market return, or the risk-free rate? What is this EIR or the error term representing? What is the error term representing? Systematic risk, unsystematic risk, market portfolio return, or risk-free rate? Of course, it is the unsystematic risk, guys. Okay, it's simply the unsystematic risk because that error term is the difference between your estimated and actual return. So difference that we observe is due to the unsystematic risk. Okay, then second one. According to Sharpe single index model, total variance of securitization can be decomposed into. Ish, you should be able to answer. What should be this? Total variance can be
Systematic plus unsystematic.
yes, systematic plus unsystematic risk. Okay. Which of the following is a core assumption of arbitrage pricing theory? Markets are always in equilibrium. No arbitrage opportunities exist in long run. All investors hold the market portfolio. Investors have identical risk aversion. As the name says, arbitrage pricing theory,
No arbitrage of
no
yes,
arbitrage
okay.
opportunities exist in a long run. Because
Long run.
whatever systematic risk that we have, that is captured in the entire model. Okay, this one. The fundamental difference between APT and CAPM is CAPM uses multiple factors while
CAPM uses single factor while APT uses multiple.
CAPM uses single factor, APT uses multiple factors. Correct. What about this? In arbitrage pricing theory, sensitivity of a security return to a particular factor is measured by alpha, beta risk premium, beta coefficient, or risk-free rate, or the market risk premium. Of course, the market risk premium.
Yes.
Yes. Okay. Look at this question. A stock follows a formula like this. The return of security is alpha plus beta into RM minus RF plus the error term. Okay. Just remove this part. Given that alpha is 2%. Okay. Alpha is 2%. Beta is 1.2. Okay. Then expected return of market is 10%. Okay. Then what will be the expected return of the security? So we have the equation over here. We have the alpha, beta, and expected return of market values. Can we calculate the expected return of the security? What will be the expected return of the security? You just have to substitute the values.
It's 12.
How much?
12 plus 2, 14.
14%?
Not this one, earlier one.
Yes. %, everyone?
Yes.
Yes, it is simply going to be equal to alpha is 2% plus beta of 1.2 into expected return is 10%. So that's 14%. Perfect. Okay, then look at this question. Beta is 0.2. Standard deviation of market is 18%. Standard deviation of error is 12%. What will be the total standard deviation of the stock? Remember, first you need to get the total variance of stock. And then you take a square root of it to arrive at the total standard deviation. Calculate the total variance of the stock, guys, first. From this, you have beta, you have standard deviation of market, you have the error term ka standard deviation also. So what will be the total variance of stock? That will be beta square into 18 square, which is variance of market, plus 12 square, which is variance of the security, variance of the error term. This is the total variance. And then we have standard deviation of stock, which will be square root of This one. So answer is 18.7. Right. So option over here is 18.7 is correct. Okay. Then let's look at the next question. Beta of security A beta of security A is 1.1. Beta of security A is 1.1. Then variance of error term is 0.1. 1 second, I don't know what's wrong with this. Editing here. Beta of security is given. Sigma is, yeah. Beta of B is given. Error of B is given. Okay. Then we have the market standard deviation as 20%. Residuals are uncorrelated. What will be the portfolio standard deviation? We have done a question similar to this in our class. So we have beta of one security, beta of another security, right? And then we have the market standard deviation as 20%. Residuals are uncorrelated. So what will be the portfolio standard deviation? Yep. What will be the portfolio standard deviation? Is assume that it is equally weighted portfolio. And first we need to get the portfolio beta. So portfolio beta will be
0.5 into,
that's 1.1 into 0.5 plus
0.5 into 0.06.
0.6 into 0.5. That's portfolio beta.
Yeah.
Right. And then we'll talk of what is the portfolio standard deviation. Portfolio standard deviation will be beta square into variance of market. So variance of market is basically 20 into 20, because that's the standard deviation of market is 20, plus 0.5 square into variance of the error term. So variance of error term. Okay, since this is given in decimal, I need to convert this in. This 20 into 20%. Then we'll say 0.5 square into 0.01 plus 0.5 square into 0.01. Yeah, that's the portfolio variance, we can say. This is the portfolio variance. So we have the portfolio standard deviation as square root of this part, which is 18.412%. Yeah, so I think this over here, yeah, 18.412%. Yeah. So option is B in that case. So we have done a similar question. Okay. Fine. So with that, we'll just stop here for the day with our MCQs being done, and also the topic of portfolio management has been completed with depth from Markowitz till the performance evaluation. So we have done quite a good number of questions, guys. Any queries? We can take it up right now. Any queries, guys? No? Okay.
Okay. Thank you, Jagbandhu sir. I think topic is over now.
Yes, topic is over.
Okay. So student, with this, we have come to the end of chapter number 8. Oh, sorry, not chapter number 8, chapter number 6. Okay. So we have come to the end of the chapter number 6, and that is a portfolio management. And in the next class, we shall start with a new topic, securitization. And if you have any query, Jagbandhu sir, just share my telephone number as well as the email ID. Overall, in these classes, the Jagbandhu sir has explained all the very important aspects of the portfolio management in a very detailed manner, as well as in diagrammatic presentation as well. So I hope the presentation and content of our classes must be very helpful for you clearing your exam. So student, this is our email ID and this is our phone number. If you have any query, you can contact us, or you can also send your query through mobile app as well. So Jagbandhu sir, thank you very much for sparing your precious time and enlightening the student on this topic on the portfolio management. And student, I thank you, all of you, for the patient listening and making this class very interactive, because your response make the class more interactive, as well as it also keep us alerted. Thank you very much and see you in the next class. Thank you.
Thank you, sir. Thank you very much.